Have you ever wondered how global companies move goods between their own branches? That is where transfer pricing comes into play. A transfer price is the internal price set for goods or services exchanged between two parts of the same company. It is a massive part of the global economy, as companies often operate across many different countries at once. Companies use these prices to track performance, but tax authorities watch them closely to ensure profits are reported fairly. Unlike a market price, which is set by outside competition, transfer prices are set by the company itself. The price chosen shifts profit from the manufacturer to the seller, influencing which country gets to tax that income. Tax authorities use this principle to prevent companies from artificially shifting profits to low-tax regions. Transfer pricing ensures fairness in global accounting. If you found this helpful, subscribe for more finance basics. Educational content, not financial advice.